you, Mr. Chairman. Just on this topic, let me just state I certainly hope that to the extent that banks have adequate capital for the circumstances that they face at any point in time, any capital beyond that should absolutely be available to be returned to the people who own those banks in the form of dividends or stock buybacks or whatever mechanism is suitable. And anything to the contrary is a terrible constraint on our economy and on economic freedom. I also want to just observe briefly, and I'm not asking for a comment on this, Chairman Powell, but if I could summarize and characterize your opening comments about the economy, I think it's fair to say that we have many areas, sectors of our economy that are performing extremely well. Housing and the goods sector, I think you referred to. And then we have very concentrated problems in certain relatively narrow sectors like hospitality and travel and entertainment, which are extremely depressed because of the circumstances. I think that clearly makes a very strong case that if there were to be further fiscal policy, it should address where the problem is and not where the problem is not. But to address monetary policy for a moment or so, I think the Fed's current forecast for growth for this year is over 4%. I think the consensus is well over 5%, with some thinking it could be considerably higher than that. The unemployment rate is now at 6.3, which is about where it was in 2014 when we were not contemplating multi-trillion-dollar bills. And I don't think we were buying $120 billion worth of securities per month. My concern is that the last two recessions were, I think, caused by asset bubbles that burst. 2001, it was the stock market. 2008, it was the mortgage credit market. In both cases, in my view, monetary policy contributed a great deal to the formation of those bubbles. The Dallas Fed president, Robert Kaplan, recently acknowledged that there's a link between the record amount of liquidity being pushed into the system and these unprecedented asset valuations that we're seeing in a whole range of assets, be it GameStop or Bitcoin or real estate, commodities. Across the board, we're seeing quite elevated asset prices and signs of emerging inflation. So I guess my question is, do you believe that there is a link between the liquidity that the Fed has been providing and some of these unprecedented asset prices?
So there's certainly a link. I would say, though, that if you look at what the market is looking at, what markets are looking at, it's a reopening economy with vaccination, it's fiscal stimulus, it's highly accommodative monetary policy, it's savings accumulated on people's balance sheets, it's expectations of much higher corporate profits, which matters a lot for the equity market. So there are many factors that are contributing to to what's happening in markets right now. Monetary policy, I would certainly agree, is one of them.
Yeah, I would just suggest that, right, I agree. All of those things are happening. All of those indicators of growth and increasingly indicators of rising inflation. As you know, the TIPS 10-year break even on inflation is now over 2%, up from 0.6%. My point is that at some point, we've got too much liquidity going into the system. The economy is recovering very, very well. Problems are isolated and should be addressed narrowly. And I hope that $120 billion a month of bond buying doesn't become a permanent situation. One of the things I'm concerned about, I wonder if you could comment on, the risk that we would have an increase in inflation, an increase in bond yields that would correspond to that, but without being back at full employment. What would that imply, which I think is a very plausible scenario for later this year? What does that imply for the bond buying program?
Well, so what we said about the bond buying program is that it will continue at the current pace, at least at the current pace, until we make substantial further progress toward our goals. And we've also said that as we monitor that progress, we'll communicate well in advance of any actual decisions, purchases. And so that's what it will take for us to begin to moderate the level of purchases. It's substantial further progress toward our goals, which we haven't really been making for the last 3 months, but expectations are that will pick up as the pandemic subsides.
Well, thank you, Mr. Chairman. I would just suggest that there are a lot of warning signs that have not been worrisome in the past, but now are certainly blinking yellow. And with that, I will yield.